Well, good morning and welcome back to the Money Advantage podcast. We're talking today about dividends. And if you've been following this show or know anything about infinite banking, this question about how do I get the best dividend rate to get the best policy performance over long term really is this question that is top of mind for many people as they're looking at trying to make the best decisions. And today we're going to talk about what dividends are and what dividend rates mean and what they don't mean, and how we can really keep dividends in the proper perspective so that we can make the best decisions with infinite banking and not get caught up in details that are really not that relevant to the long-term performance of your infinite banking policy. So I'm joining Bruce Wayner this morning as we are co-hosting this show. And Bruce, I really appreciate the just tireless ability to keep sharing truth about infinite banking and being able to break this down in practical terms for people. Thank you for joining me for this important conversation and this topic today.
Yeah, this is one of those topics that you know people look at their financial life, and oftentimes there's a lot of abstraction to their financial life, and they wanted to quantitatively analyze that because they think that is the way that they're going to get ahead. But the problem with quantitative analysis is you make assumptions about fixed rates, fixed returns, fixed needs for money, all these assumptions, where qualitative analysis, you are actually just looking at the whole picture and realize that factors change all the time. And so you need to actually change with the times. And so the problem with that is, or with quantitative analysis, is life gets in the way. I say that all the time because you set on a 25, 30, 40, 50, maybe 7 generation path, and things change. Some of them are in your control, but most of them are out of your control.
Mm-hmm.
But there's a comfort because we have these calculators, even in our phones nowadays, that people say, well, all I have to do is punch this in and I'm going to get the answer. And I say, well, that's great, but what's the time period? Because the time period is very, very important. And because then we take the time period out to a known time that you believe, or excuse me, what you believe is going to be a known time, let's say 10 years, and you're basing that 10 years on the previous 10 years, the historical 10 years. But the next 10 years historically could not be anywhere near what they were the previous 10 years. Why? Because you have different economic policies by the government. You have different technological innovations that will either bring up costs or bring down costs. You have worldwide influences such as war, famine, disaster, all these different factors that can actually change the next 10 years. But it's comforting to people to say, well, historically, this has happened. When they're looking at a small sample size, though, that can be skewed. If you're looking at a longer sample size, you can smooth that out a little bit. And luckily, these mutual companies have been in business for 120 plus years. And so they have more historical data. So it's not perfect going forward, but at least it's going to smooth out. So, Rachel, that's what I want people to think about on the podcast today, is that you actually have to look at a time period, and those time periods for you might be 10, 20, 30 years, but the time period for insurance companies are in perpetuity. They're making decisions over literally hundreds of years. In your case, with your book, 7 generations, they're making decisions.
And Bruce is referring to 7 generations legacy and this idea and this concept of being able to create something that you can benefit 7 generations ahead. And the thinking required to be able to do something of that proportion means that you have to put systems in place that you yourself cannot fully control. You're putting them in motion. You're being the impetus, the starting point, the spark that starts something and you're creating a system that will continue to work for you, but it's not something that you can just work within a short time frame. You're wanting to look long range so that you can even make better decisions. So I am going to ask you as well, Bruce. I know you put a comment in the chat to ask your questions. I would like to invite your questions about the topic of infinite banking or the topic of dividends and your questions surrounding dividends. Why do dividend rates not matter? Why do they matter? What are dividends? Whatever your question is, we'd love to hear that question, because as we approach this concept and this conversation today, what's top of mind for you is going to help bring the conversation more full circle and make it more robust. So what are we talking about? If you're new to this idea, you're saying, what in the world are we even discussing? We're talking about infinite banking, which is a process of being able to use a specially designed whole life insurance policy from a mutual company that pays dividends, that builds cash value. And the reason that you're using this policy is not just for the sake of the life insurance aspect, but what you're also doing is you're building up cash value. You're becoming the banker, as Nelson Nash said. And what you're doing is being able to store capital where you can access and use it without interrupting the compounding. Now, one of the key components of the growth that happens inside of this policy for you that gives you a huge advantage are dividends. Now, when we say a dividend, that means a component of the growth of the surplus of the life insurance company that is distributed to policyholders, because it's a mutual company, and because when you're a policy owner, you are a part owner in the company and you're entitled to that return of company profits. Now, dividends are not guaranteed. If you're thinking that dividends are the only growth within a life insurance policy, that would not be accurate, because you have the guaranteed interest growth and you have non-guaranteed, but we always say, but highly anticipated dividends, because they've been paid for decades, even through the greatest challenges in American history. So when we look at that concept, what can be very quickly the next question on somebody's mind who says, I want to control capital, I want to become my own banker, I want to have this pool of reserves that's growing faster than any other comparable product to store liquid available cash. It's accessible for me to be able to use through policy loans. Now, I want that to grow as fast as possible so that in the future I have the most options. And the first thing that our mind can go to is, well, if this company A, says, here's my dividend rate, and company B says, here's my dividend rate, and company B is a few percentage points down from company A, our mind can quickly say, company A must be the better choice. It shows a higher dividend rate projected into the future, therefore that policy is better. And so it comes down to a lot of illustration comparisons. And so that's the question we're addressing today. So Bruce, I know that this is something you hear on an everyday basis. What do you think is the most important thing for somebody to first recognize when it comes to dividend rates?
Okay, so we haven't brought this up over the last 6 or 7 years very often, but people get the impression that cash value is actually money. But when you think about the actual phrasing of cash value, it's actually saying it in the two words. It's the value of the cash within your policy. It's not actually money. And that's an interesting little thing. So the actuaries have just basically said that if you surrender the policy, this is the amount of value you have that we will then transfer into money and then give you back that money. That's a little bit of a interesting thing to think about, but what it means is then you can't really look at this as a rate of return on your money because there's so many factors. So the first thing I think people need to understand is dividends are not a percentage of crediting on your particular cash value. So example, you cannot take, if a company declares a 5.5% dividend, you cannot just say, oh, my cash value is going to grow by 5.5% that year. Why can't you say that? Because that 5.5% is a gross dividend in many cases, does not take in consideration the fees. Some of them do take consideration of some of the fees, and this is the problem. There is no industry standard, and all the insurance companies say this on their advertisements and their brochures. They say there are no industry standards for this, and yet they do declare a dividend in the form of a percentage, but it's a percentage for the pool. And that's
So,
probably the first thing that you need to understand.
so Bruce, when you say no industry standard, what you're meaning is there's not one way of determining the dividend, and the calculations to acquire the dividend rate are not equivalent from insurance company A to insurance company B. They may arrive at a dividend rate differently. So one may factor in costs, one may not factor in costs. And that may be their gross dividend that is then applied differently to each policy owner who has had their policy for different lengths of time. And I think the simplest way to say that is those who have contributed most to the growth. That was a complicated thing to say. Most contribution to the growth of the insurance company's profits then are able to receive a higher percentage of that gross dividend, whereas those that have not contributed as much will not be receiving as much or be compensated as much for their contribution to that growth. So when you say there's no industry standard, it doesn't mean that they're all, rednecks and running wild and doing whatever they want. What it means is that there's not one way that determines the dividend rate. So when you compare two dividend rates, they did not arrive at those based on the same exact equations or calculation.
How they even dividend comes about. So every policy includes by contract a guaranteed interest, and that guaranteed interest rate is in your contract and it cannot change. So you're going to get that. The guaranteed interest rate is also included in the dividend crediting rate. So it's part of the dividend crediting rate. So example, if a dividend is 5.5% and the guaranteed growth rate is 2%, then that 2% is part of the 5.5%. And that has to be understood. So how does a dividend come about? Well, the company has premiums that come in every month, and then they actually deploy those premiums in a variety of ways. About 85% of it is in fixed incomes, bonds, both treasury and corporate bonds, mortgage-backed securities, real estate, a sliver into securities, and a sliver into derivatives. They go out and make money. They have expenses. What are their expenses? Their home office building is an expense. The labor is an expense. Paying their agents is an expense. But the greatest expense is mortality expenses. People dying and they're paying the death benefit. So what the CFO, the chief financial officer, at the end of the fiscal year, they look at all the money they made. Oh, by the way, they also make money on policy loans by charging an interest. And so it's one of the ways that even though you're paying interest to the company, you're actually helping the company make money, and then you actually get that back in the form of a dividend. Now, you don't get it back one-on-one, but it helps. It would be analogous if you had shares in a bank and you went to the bank and got a loan, you're paying interest to the bank, and the bank's becoming more profitable. Their stock price goes up, so your share values go up. It's the same concept. So at once a year, the CFO looks at all this, and this is where one of the industry standards is different, Rachel. Is yes, they have some different calculations, their expense ratios are different, but a big difference I shouldn't say a big difference. One of the significant differences between one company and others, how much they want to put in reserve. So what they're going to do is they're going to get a profit amount. They're going to put some of that profit in reserves. Some companies for a particular year may put more profit in reserve because they feel like we're going into some some tumultuous times and they want to have more capital in reserve. Other companies that might have already have a bunch of capital in reserve, they might not put as much in reserve. So the top 10 companies have about a 7% over their reserve requirements of 100%. The better companies have actually twice that amount. So just think about it. If they have twice the amount in reserve, is their dividend crediting rate probably going to be a little lower? Yes, because they put money in reserve. However, those companies will be more stable in the future if the economy changes because they have more money in reserve. Thus, they can maintain their dividend crediting rate more than a company that doesn't put as much money in reserve.
So if we
So,
look at that and we think of just mathematics, you're saying we've got the profit of the insurance company minus expenses minus what they're putting in reserves. So a company could have a higher dividend rate if they were more profitable, or if they had lower expenses, or they put less in reserves.
correct.
So you would think, well, to be fiscally responsible and to make the best decisions, high profit, great decision. Low expenses, probably good, depending, I mean, if they were cutting corners that made things that were not as good for the policyholder, maybe that would not be good. You could also think about growth. Well, if they're taking more risk to get that growth, that might not necessarily be good for you long term. And then if they're putting less in reserves, that's not necessarily indicative of long-term level stability, whereas more in reserves is going to have more stability. So what you're saying, Bruce, is that it's not necessarily ideal to have the highest dividend rate anyways, because some of those factors that would push a dividend rate up would not necessarily be ideal for the long-term stability of an insurance company.
I don't know if I would agree about the long-term stability.
Mm.
If that word means to some of our listeners they're in trouble going out of business,
Oh, sure.
but I would say long-term volatility. In other
Okay.
words, the peaks and valleys of how the dividend rate goes up and down. A more conservative company may actually keep their dividend rates fairly set the same over time, where a more aggressive company may say, well, we're going to raise the dividend rate. We think this tumultuous time's not going to hang on very long. We're going to be able to ride the storm out with our reserves. But if they're wrong, now they have to actually pull them down a lot, where the other company says, we were able to ride the storm out because of our philosophy of being conservative. Now we have more in reserve. So when the tumultuous time hit, we don't have to lower our dividend, or we may actually have a higher dividend. So it gets down to what we've talked about several times in this on this channel is actual rates of returns and average rates of returns are not the same.
Mm.
And so you could have a company that's very conservative on their dividend rate, but it doesn't go up and down, and actually outperform one that keeps their dividend rates very, very high, but then all of a sudden they have to drop them for several years to be very low and have a greater average than the other one had.
Which,
So it's
Bruce, what's
very interesting.
really interesting about that is that if you look at a policy illustration, the illustration will show you a dividend rate based on today's projected dividend rate going into the future. So let's just say we're in a time period where company A is showing a higher dividend rate than company B. Company A is going to show higher cash values then over the lifetime of that policy, because that's a projected idea of what will happen if the dividend rate stays high. During which time, if you compare an illustration at that moment in time for company B, where their dividend rate is showing a little bit lower, their long-term growth in cash values and dividends are going to show less on the illustration because they're basing it on a more conservative number. So in that moment in time, company A looks better. I'm going to perform better. The thought is, if I purchase this company A policy, with the higher dividend rate, then I will end up with higher cash value, higher growth inside the policy, and better performance. The challenge is, well, if we then illustrate that same company in a different environment where now company A has to pull down their dividend rate, like you mentioned, now company B may illustrate longer term into the future a higher cash value amount. So Bruce, would you say that it's pretty fair that ultimately, whether the dividend rate is higher or lower, that generally all of the mutual companies are going to end up around the same amount of growth over time?
That's a good conclusion. I was going to actually that conclusion finish. Let me just bring this up now. I know people that are listening cannot see what I'm bringing up, but we try to stay fairly agnostic when it comes to insurance companies. Although we do have ones we prefer, we don't base it upon dividend rates per se. We base it upon their acceptance of the infinite banking concept. And why do we say that? Well, companies that accept the infinite banking concept actually then set their customer service up to actually respond to taking loans and paying back loans. And it's a much greater experience for the customer. Not all companies believe in that. The next thing you need to know is that every insurance company is in the business to make a profit. And so they're going to have marketing tools, which include dividend rates, to actually market their company as being better. So right now, we have a marketing piece that looks like Lafayette Life would be on top. Why do they put this out? Because they said, and this is what you were saying, Rachel, is that in 2019, Lafayette Life takes a 5.1% dividend crediting and takes it all the way out to 121 years on their illustrations without change. And that's how all the companies do it. So then you go down here to Penn Mutual, and Penn Mutual did the same thing in 2019. Their illustrations were taking the dividend rates and throwing it all the way out into the future to age 121 for that particular client. The difference is when you would then put Penn Mutual against Lafayette Life in 2019, if you were just using a snapshot in time of illustrations, you would have looked at it and said, well, Penn Mutual is going to beat Lafayette Life. And they do on the projections. However, Lafayette Life, and oh, by the way, Northwestern Mutual, also the biggest company in the mutual space, and they have a 100 Comdex score, which is a perfect Comdex score. Lafayette Life has a 96 Comdex score. They actually are even more conservative with their crediting than Lafayette Life. And you would think a big company like Northwestern Mutual that has all these capital reserves would actually be able to say, hey, we're going to use our capital reserve to actually boost up our dividend, which some people have accused Mass Mutual of doing that, to use their capital, because they're also another big company, to boost up their revenue. You have two of the big giants of the mutual companies, Northwestern Mutual and Mass Mutual, that have totally different philosophies. And yet, Mass Mutual and Northwestern Mutual, their deal flow, or how much money they bring in every year, is massive, even though they have two different philosophies. So I think one of the takeaways you should take is that look at the difference here. You have a 5.0 all the way up to a 6.4. And all of these dividend ratings are actually not that different when it comes to the illustration when you compare them side by side. Now, when I say they're not that different, I'm going to give you an example. You know, like Penn Mutual at 6.1, they may beat Northwestern Mutual by $25,000 after 30 years. Now, that's assuming, once again, Penn Mutual is doing 6.1 over the entire 30 years. and Northwestern Mutual's doing 5.0 over the entire 30 years. But as we already can see, the actual thing happened is Penn Mutual then had to drop their dividend crediting by 35 basis points, and Northwestern actually raised it by 15 basis points. And Lafayette Life is touting that, hey, look what we've done. We've actually done such a great job over the last few years because we were conservative during a very tumultuous time of low interest rates, that now as interest rates start to tick up, we can actually take advantage of those rising interest rate environments, where you would think that would happen with everybody. But these down here, these three companies, and this is the Ohio National, these three companies have actually had to lower their interest rates, even though in the last 2 years, the interest rate environment has increased, and they didn't increase it. So my point of this, showing you this, is that crediting really doesn't matter on the initial illustration, and crediting long term shouldn't matter that much relative to the conservative nature of every insurance company, or they wouldn't be in business and doing as well as they are. If you want to take one thing in consideration, I would say right now, because we're coming out of low interest rate environments and we're going into a normalized interest rate environment, the more conservative the dividend crediting rating is, you're going to get nice surprises into the future, just like we've seen in this right here over the last 6 years.
Bruce, I think that's just a fascinating picture of what's happening, and really dividends being a projection of what the insurance company expects going forward, and being able to maintain their reserves and also be in a position of providing a benefit to policy owners. I mean, every insurance company would want the best of all worlds. They would want the highest growth, they would want the lowest expenses, they would want the most in reserves and the highest dividend rate. But these are all balancing pieces that they're working to get the best projections and the best performance over long term, and they're working out all of these things to make sure they are going to be strong into the future. And so I think this is fascinating to look at which companies maintained high dividends in a time frame that was challenging, and which ones are lowering them now versus which ones are raising dividend rates, which just again goes to show that it depends on when you provide an illustration which company would look better, which is the reason why you have said for so long illustrations really don't matter. So the challenge is that our logical mind can try to grab onto the quantitative actual numbers, like you said at the beginning, Bruce, and say the numbers need to make sense for me to move forward with this policy, and the easiest tool we have to look at is an illustration. But the challenge with doing that is that we really don't want to get into comparing on the basis of a number that really is not that important. The ultimate goal is to have a policy that has the guarantee of cash value, the guarantee of death benefit, the guarantee of no increase in premium, and the ability to take policy loans. And when you have that, you have something that's going to work for you, which is why I love to think about things conceptually rather than just analyzing all of the numbers. If you analyze all of the numbers, you will end up probably drawing the wrong conclusion.
Volatility of this proves that. If we go, and now I'm going to go to the second one, and Rachel, please tell me if I'm sharing properly. So this one, I'm going to have to stop sharing, it looks like, and then redo this. Volatility of one particular insurance company.
Okay, now I see you sharing. Yes.
Okay, so this one, 1990, this particular insurance company had a dividend rate of 9.85%. Well, if you took out a whole life insurance contract at that time and then reviewed it in 2014, where it had dropped to 5.1%, then you're going to be disappointed in your original illustration.
Mm-hmm.
However, if you take one out in 2014 and we return to these type of numbers in the future, a lot of people look at this and they think that their cash value is going to be 100% greater than what was illustrated.
Mm.
And in fact, it will be actually greater than that because you're getting the compounding effect of the previous year's growing. So the reason I brought this up is you can show illustrated values and you think, oh, this is a better company to go with than another company. And then some people actually look at historicals. And I say you can't even really look at historicals because other factors have changed during that time. And one is the guaranteed cash. So the last 7702 change, which is the IRS tax code of how you can actually have cash value ratio to the MEC limit of the death benefit, actually brought down the guaranteed interest of these contracts to as low as 2%. However, some companies, for marketing reasons, actually only lowered it from 4% to 3.75%. But that puts more pressure on them for their guaranteed side. So now they don't have as much room for their dividend side. So they still come out about the same. And they tout, oh, look how strong we are. You know, don't worry about dividends aren't guaranteed. But even if you don't get a dividend, you're going to have guarantees here. Well, they're the same argument from the same company comes about and says, we've always paid dividends in our entire history. So once again, it's about marketing your particular product niche that you have. So don't get caught up. This is why Nelson Nash said, rates don't matter. Interest rates don't matter. And the reason he said that is because interest rates go up, interest rates go down, but the need to store capital stays the same. And I'm going to finish this today by saying I can prove it to you because banks work on interest rates. And banks' interest rates go up, they go down, and people still store money in the banks. When banks were paying you zero for your money, the Federal Reserve reported that across the United States, people still stored $17 trillion in banks in the United States. So do interest rates matter then? No, they do not matter.
Mm-hmm.
What the most important is that you're storing capital.
Bruce, I think that is the key to this whole thing, because the challenge can be to look at something that we think is the most important point or the key element or the critical nature of infinite banking, and that can mislead us to overanalyze and be forever stuck in a perpetual decision-making process rather than moving forward. I actually got really excited when you showed the dividend rates that used to be about 9.85 and now they're lower today. What that showed me is that, you know, it can be really easy to look at policies that were illustrated back in those early years, 20 years ago, 30 years ago, and say, oh, those performed much higher than what we see in the illustration environment today, what we're shown on illustrations. But the potential to go up in the future is really powerful, which means that what you're getting on an illustration on the guaranteed side is just a worst case scenario. And that's even a bad way of saying that, because you know that if you get paid a dividend, then your worst case scenario, the guaranteed side, is going to even go up because of the dividend, which becomes a part of the guarantees as soon as it's paid. And so the value of all of this is it's focusing on getting a infinite banking policy so that you can store cash with the best tool for being able to access liquid capital and maintain the banking function. What I mean by that is that you're storing cash that is growing. You're able to borrow against it, which means you keep your cash compounding. It continues to grow and you're not interrupting that growth. You're not subtracting out or minusing out your account. You're not depleting it down, which then causes you to have to restart the growth when you refill your tank, as in a savings account. Instead, you're in a position where you can truly build compounding and have that compound growth happen inside of your policy. And so your ability to store capital, your ability to access capital through policy loans, those are the most important things, which is why if you are considering infinite banking, now is a perfect time to be able to start a policy. And it doesn't even have to be the perfect policy, but get an infinite banking policy, start capitalizing that policy, and you will watch your financial capabilities just continue to grow in the future. So with that
Great
being
synopsis.
said, let's go ahead and wrap up the show today. Thank you for being with us. And if you have questions in the meantime, as you're listening after this show has been live, you can ask those in the comments. You can also send those to us at hello@themoneyadvantage.com. But mostly, I encourage you to book a call with our team. You can go to themoneyadvantage.com and book a call where you can find out how to apply infinite banking in your own life and get started today. So thank you so much for being with us on the show. We appreciate you, our listeners. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.